Welcome back to the Deep Dive. Today, we are tackling a subject that, well, I know for a fact it keeps a significant portion of our listeners awake at night.
Oh, absolutely.
If you work in private equity, if you run a search fund, or if you're managing a family office, you know this pain. You know it intimately.
It's a very specific kind of frustration, isn't it? It's this paradox.
Exactly. It's not a lack of money.
Not at all. It's the feeling of drowning in data while at the very same time starving for actual actionable insight.
That's the perfect way to put it. We're calling it the information gap in modern deal making.
And it is the defining challenge of the current market. If you look at the macro figures, there's absolutely no shortage of capital. Dry powder, that capital committed but not yet allocated, is sitting at record highs.
Trillions, right?
We're talking trillions of dollars just sitting on the sidelines. The money is there. The problem is not the capital. It's the liquidity of information. It's the massive friction involved in finding the right home for that capital.
Right. And that's exactly what we're unpacking today. We're looking at how the industry is, well, it feels like it's transitioning, moving from what we could call the information age.
Where you just have these huge static databases, basically glorified phone books.
Yes, to what our sources are calling the agentic age, an age where AI doesn't just store data, it actually reasons, it plans, and it acts on it.
It's a fundamental shift in the operating system of capital allocation. I mean, we're moving from a world where you hunt for data to a world where the data, in a way, hunts for you.
To guide us through this, we have a really fascinating stack of documents today. We're looking at internal strategy playbooks from a platform called Synergy AI.
And they're positioning themselves not just as another tool, but as a tech-enabled brokerage.
We also have some broader industry reports from Moore, Belgium, PitchBook, State Street, and even some deep legal analysis on AI's role in M&A.
You know, what really stands out in these sources is the sheer ambition of it all. We're not just talking about a faster search bar or a slightly better Excel plugin.
No, not at all.
We're talking about Synergy AI and platforms like it positioning themselves as an operating system for capital.
I love that phrase, operating system for capital. It sounds grand, but let's ground it for a minute. The mission for this deep dive is to explain how this tech moves deal sourcing from being reactive.
Waiting by the phone for a teaser to land in your inbox.
Exactly. Waiting for an auction process to start, to being truly proactive. We're talking about the algorithmic discovery of those off-market hidden gems.
And that distinction, reactive versus proactive, that's everything. In a reactive model, you are competing with everyone else who got the same teaser from the same investment bank.
Which, of course, drives up multiples.
Inevitably. It leads directly to the winner's curse, where you win the deal, but you've overpaid so much that your IRR gets crushed. The whole goal of this new tech is to find the deal that nobody else even knows exists yet.
Okay, let's unpack this. To really understand where we're going, we have to look at where we are. This is segment 1, the paradigm shift. The sources, they describe the current state of sourcing as relying on these legacy databases.
We all know the names, PitchBook, Crunchbase, you name it.
And the sources are pretty harsh on them. They call them static and lagging. Why is that? What's the core problem?
It really comes down to the fundamental architecture of how the data is organized. Historically, if you wanted to find a company, you had to rely on industry classification codes.
SCC codes, NAICS codes.
Exactly. These were developed decades ago to categorize a primarily industrial economy. You know, manufacturing, retail, agriculture, simple boxes.
Right, you just check the box. Code 301 for food manufacturing and you get your list.
But the modern economy isn't like that. It's hybrid. It's fluid. So let's say you have a thesis. You want to find a company that makes AI software for dental inventory management.
Okay, very specific.
And you go into a legacy database and try to search for that using codes. Where does that live? Is it dental equipment? Is it general software? Is it healthcare services?
It's probably buried under general software along with 50,000 other SaaS companies that have absolutely nothing to do with dentistry.
Precisely. That is the code problem. The company you want, the needle, is buried in a massive haystack of irrelevant data. And this forces your associate, your analyst, to manually sift through thousands of entries.
That's the friction. It's why sourcing is so expensive and so slow.
And the shift we're seeing now with platforms like Synergy AI is moving away from those keywords and codes and toward what they call semantic inference and context vectors.
Semantic inference. Okay, that sounds very sci-fi, and I want to make sure we don't just gloss over it. What does that actually mean for the deal maker sitting at their desk? How does the machine think differently?
It means you can search by concept, not just by keyword. So instead of typing in a code, you input a thesis. You might actually type in a sentence like, find me Belgian B2B SaaS companies with 2 to 5 million in ARR that show signs of bootstrapped efficiency.
So you're describing the nature of the business, not just its category. But wait a second. Bootstrap deficiency. It's a subjective term. How does an algorithm know what that is?
That is where the context vectors come in. The AI breaks down a concept like bootstrapped efficiency into a whole series of data signals. It knows that concept implies a high revenue per employee ratio.
Okay.
It implies a lack of news about a Series A or Series B funding round. It implies steady organic growth in web traffic rather than the huge spikes you see from a VC-backed ad spend.
I see.
So it scans the open web company websites, LinkedIn, news articles, registry filings to find companies that match that fingerprint, even if the company's own website never once uses the word efficient.
Wow. That is a game changer. You're profiling the company based on its behavior, not just its self-description. But there's another term that pops up a lot in the Synergy AI documents that I think we need to define very clearly: Agentic AI.
Yes.
They make a big distinction between this and generative AI.
And this is a crucial distinction. I'm glad you brought it up. Generative AI, like the chatbots most people are familiar with now, is great at creating content. It can write an email for you, summarize a PDF, draft some marketing copy.
Right, generates text.
But it doesn't really do anything in the real world. Agentic AI implies agency. It can plan and then execute a multi-step workflow.
Okay, give us an example. An agentic workflow in sourcing. Walk us through the steps the machine would take.
Sure. So let's say you've identified a potential target. A generative AI might just summarize the company's About Us page for you. An agentic AI, on the other hand, would be given a goal. Qualify this target.
A command?
A command. It would then autonomously create a plan. Step 1. Check the website to verify the product actually fits our investment thesis. Step 2. Cross-reference the founders on LinkedIn to check their tenure and their backgrounds. Step 3. Look up the company in a corporate registry to verify the founding date and ownership structure. Step 4. Synthesize all of that distinct information into a final verdict. It's reasoning, step by step.
So it's acting like a digital analyst, not just a writer. It's actually performing the due diligence tasks.
Yes.
But this is where I get skeptical, and I think a lot of our listeners will too. We hear about AI hallucinations constantly.
All the time.
It just invents facts. If I'm doing due diligence or even just initial sourcing, I absolutely cannot have the AI making up revenue numbers or inventing founders.
That is the #1 barrier to adoption in finance. It's trust. You cannot have a hallucinating analyst on your team. The source material addresses this head-on with a concept they call grounding, specifically grounding with Google search.
Okay, how does that work technically? What does grounding mean?
It's essentially a layer that sits on top of the AI model, and it forces the AI to cite its sources for every claim it makes. It combats hallucination by anchoring every single output to a verifiable URL.
Oh.
So if the AI says, this company has 50 employees, it doesn't just say that. It provides the link to the LinkedIn Insights page or the About Us page where it found that number.
So it makes the data auditable. You can check its work.
Exactly. And in the Synergy AI playbook, they emphasize this heavily. They say, our AI doesn't guess, it cites. For any PE firm, that audit trail is non-negotiable. You need to be able to click the link and see the source of truth for yourself.
It changes the dynamic from trust the machine to verify the machine.
Precisely. And that's a much more comfortable place to be for an investor.
That makes so much sense. It bridges the gap between the black box of AI and the rigorous requirements of finance. And once you have that trust, you can start doing the really interesting work. Which brings us to segment 2, and honestly, for me, this is the real meat of the episode.
I agree.
This is the core logic of this news sourcing model: signal detection.
This is where the rubber really meets the road. The whole premise is that before a company ever hires a banker, long before they send out that teaser, there are signals, little breadcrumbs in the public domain that suggest an owner is ready to sell.
And the AI is just constantly scanning the open web to find these triggers.
24/7.
Let's break these down because the examples and the sources are just fascinating. The first one they talk about is the succession and demographic signal.
This is particularly relevant for, say, family offices and search funds that are looking at these great legacy businesses. The AI monitors local business press. So in Belgium, for example, it's reading L'Echo or De Tide.
The local business journals.
Right. And it's looking for articles celebrating milestones, like a company's 30th anniversary.
Now, hold on. A 30th anniversary doesn't immediately sound like a sell signal to me. It sounds like a party. Why does the AI flag that?
It is a party, but for a deal maker, it's also a demographic marker. If a founder started a business 30 years ago, they are very likely approaching retirement age.
Good point.
The AI then analyzes the language in those articles. It's looking for keywords like legacy, next chapter, or handing over the reins, but it goes so much deeper than just finding keywords.
Right, the sources mentioned this idea of the negative inference. This blew my mind. Explain how the AI finds something that isn't there.
It's a brilliant application of logic. So the AI scans the article not just for what is written, but for what is conspicuously absent. Imagine a puff piece about a founder's 30 years of success.
Okay.
The AI scans that text for any mention of a son, a daughter, or any family member being involved in the business. Then it cross-references the board of directors and the senior management team on the company website.
And if it finds no family members mentioned in the article and none on the website,
Then you have the negative inference. If there's a big celebration of the company's past, but zero mention of a second generation joining the firm and no next gen on the board, that suggests the founder has a potential succession problem.
a liquidity problem, really?
Exactly. They have a valuable asset, but no one to leave it to. That makes them a high probability target for a search fund or a PE firm to approach with a legacy preservation pitch.
That is so smart. It's reading between the lines at an industrial scale. You're finding the owner's pain point. Who will take care of my baby? Before the founder has even verbalized it to a broker.
You're solving a problem they might not have admitted they have yet.
Okay, let's look at the next category of signals. Distress and liquidity events. This gets a little darker, but, it's the reality of the market.
This is what the sources call the event processing engine. It moves beyond looking at corporate metrics to looking at human events. We are talking about the D words: death, divorce, disease.
And the sources specifically mention the AI monitoring legal filings for divorce decrees or probate.
They do. And there's a specific example in the notes about the Maclo collection.
That's art, right? Not a company.
It's a classic example from the art world, but the logic applies to any asset, including a company. The Maclo collection was one of the most valuable private art collections in the world. We're talking Rothko, Warhol, Giacometti.
Wow.
And it didn't hit the market because the owners suddenly decided they hated art. It hit the market because of a bitter, very high-profile divorce. The court ordered the collection to be sold to split the assets.
So the signal there for the AI would have been the legal filing itself.
Yes. The AI detects the divorce filing involving a high net worth individual. It infers that a major liquidity event is imminent. If you are a broker or a buyer, knowing that before the assets are publicly listed gives you a massive advantage.
You can get in front of the process.
You can approach the owners with the solution. I can provide quick, discreet liquidity before the auction house even gets involved and it becomes a public spectacle.
It feels a little predatory, but I guess incredibly efficient. You're stepping in when the seller needs speed and certainty more than they need the absolute highest price.
That's a great way to put it. Liquidity needs drive transactions, and distress just accelerates those liquidity needs.
Okay, let's shift to something a bit more operational. Signal Type C, operational and hidden gem metrics. This feels like it's geared more toward the growth equity crowd.
It is. This is all about finding signs of performance that aren't reflected in the financial statements yet, or at least not in the public ones. For instance, the AI looks for what it calls bootstrapped efficiency.
What does that actually look like in the data? What's the signal?
It looks for high revenue per employee ratios in companies that haven't raised any VC money. So if a company has 50 employees on LinkedIn, that implies a certain cost base. If the AI estimates the revenue based on web traffic and online pricing at, say, $10 million, and they have zero Crunchbase funding history, what does that tell you?
It tells me they are paying for all their growth out of cash flow. They're profitable.
Exactly. They are a quiet, money-printing machine that has never taken outside capital. That is the definition of a hidden gem.
But the AI can also find the opposite, right?
Yeah.
The sources mention technical debt as a signal. This one seemed really cutting edge to me.
It's fascinating.
How does an AI sitting outside the company possibly know about their internal technical debt? I mean, does it hack their servers?
No, nothing illegal. It analyzes public code repositories like GitHub. Many tech companies have public repositories or contribute to open source components. The AI analyzes the change request backlog.
Okay, what's that?
It's the list of bugs, feature requests, and issues. If there's a massive growing backlog of unaddressed issues, or if code refactoring is stagnant, it signals technical debt. The system is becoming unmanageable.
So it's looking at the code hygiene from the outside.
It's looking at the activity. It can see the commit velocity, how often new code is updated. If that velocity drops off a cliff, it could mean the lead engineer quit, or maybe they've run out of money to pay their developers.
It's a proxy for operational health or distress.
It's digital forensic analysis before you even sign an NDA.
It's incredible how much signal is just floating out there in the open web if you know how to look for it. But finding the signal is only step one. Step two is dealing with the flood of opportunities once you turn this machine on.
Absolutely.
Which brings us to segment 3, the workflow revolution.
And this is the operational bottleneck in almost every firm, the associate problem. In a traditional setup, you have these smart, very expensive MBA graduates spending, 80% of their time just reading pitch decks and manually entering data into Excel?
It's a massive waste of human capital.
Yeah,
And the burnout rate is huge.
it is. So the Synergy AI solution here is what they call the deal qualifier module.
Mm.
The whole idea is to automate the associate. You can upload a pitch deck, a PDF, a PowerPoint, or even just a company URL.
And the AI reads it instantly.
Instantly. And it doesn't just summarize it, right? It judges it.
That's the key.
That is the key. It gives you an instant verdict. It assigns a synergy score based on your firm's criteria, and crucially, it generates a list of red flags.
The sources claim this can reduce that initial diligence time by 60 to 80%. That's a massive efficiency gain. But they also mentioned it reduces something called deal fever. Can you explain that?
Deal fever is a well-known psychological trap. It's sunk cost bias. If an associate spends 2 weeks, maybe 100 hours analyzing a company, building the financial model, talking to the founders,
They get attached.
they get attached. They subconsciously want it to be a good deal. They've invested their life into it. They might start to gloss over a risk or a red flag just to justify the time they've already spent.
They want to get it across the finish line. They become an advocate for the deal rather than a neutral analyst.
Precisely. But if the AI analyzes that same deck in 3 minutes and spits out revenue is declining, customer concentration is dangerously high, pass, there is no emotional attachment. You can kill the bad deal instantly and move on to the next one.
That objectivity is incredibly valuable. But there's another concept here that I found really compelling, the triage log. This is about building institutional memory.
This is, in my opinion, the most strategic part of the entire platform. In manual sourcing, when you pass on a deal, the reason why usually just disappears. Maybe you mention it in a Monday morning meeting, oh, the valuation was too high, and then it's forgotten forever.
Gone into the ether, just lost knowledge.
Exactly. But Synergy AI records that reasoning. It builds a triage log. It forces you to record. Rejected company X because of customer concentration risk. Over time, this creates what they call a data moat.
So the AI learns what your firm specifically doesn't like.
Yes, it actually trains the model on your firm's specific risk appetite. If you keep rejecting companies that have low recurring revenue, the AI learns that and stops showing them to you. It's a feedback loop.
So sourcing is no longer just a cost center.
It transforms sourcing from a cost center just spending money to find deals into a compounding intellectual asset. Your proprietary database gets smarter with every single deal you look at and every deal you reject.
That really is the difference between a static list and a truly intelligent system.
Yeah.
Now, we've been talking a lot about companies, SaaS, family businesses, but the source material really emphasizes that this technology is versatile. It's not just for buying companies.
Right. It's for buying assets.
This is segment 4, the versatility of the platform. The Synergy AI documents detail these modules for art, real estate, and even other niche assets. And the case studies they provide are fascinating because they show the depth of the analysis. It's not just about finding the asset, it's about structuring the deal.
They really show the system's ability to think like a principal, not just an analyst.
Let's talk about the art case study because it was wild. The Dali sculpture collection, this wasn't just find me a Dali, it was way more complex than that.
It was, and this highlights what they call the matrix assets analysis. The huge challenge with bronze sculptures is authenticity and reproduction rights. The AI had to navigate the very specific legal status defined in a 1974 act regarding unnumbered copies.
The sources mentioned lost wax microfusion. That sounded incredibly technical for an M&A document.
It is technical, but it's absolutely crucial for determining value. Lost wax microfusion is the casting process. The AI needed to understand that specific term because it relates to the biological link to the artist.
A biological link.
Yes, the original wax model that Dali created captures his actual fingerprints in the wax. The AI helps market these complex assets by creating these digital dashboards that prove the provenance. It's using tech to verify founders' rights and authenticate the asset via those biological links in the bronze.
So it's acting as an art historian and a lawyer combined. Incredible.
In a way, yes. It's structuring unstructured complex data so a buyer can have confidence in what is a very opaque market.
Then there was the real estate case study. Martin's Hotels. This is a hospitality chain in Belgium. What was the AI's angle there?
The green angle. The AI identified what it called an inevitable investment risk. These are beautiful historic buildings, but that also means they're likely energy nightmares. The AI flags the regulatory risk things like asbestos, fire safety in historic structures, and new EU energy directives that are coming down the pike.
But it didn't just flag the problem, did it? It also found a solution.
It identified specific financing options, in this case EIB, European Investment Bank, loans that are earmarked for green capital expenditure. So it matched the problem, old inefficient buildings, with the solution, cheap available green debt.
And it even suggested a deal structure.
A PropCo-OpCo split. The AI suggested that the deal could be structured by selling the PropCo, the real estate itself, to one type of buyer who likes steady, long-term yields.
Like an insurance fund.
Exactly. And the OpCo, the hotel business operations, to another buyer who is comfortable with hospitality risk. It deconstructed the deal to unlock value for different types of capital.
That is incredibly sophisticated structuring. Okay, the third case study was the Hungarian vineyard. This one sounded like a legal nightmare.
It's a perfect example of what they call regulatory complexity. Hungarian agricultural law is very protective. It gives preemption rights to local farmers.
What does that mean exactly?
Basically, if you, as a foreign investor, try to buy a vineyard, the local farmer next door has the legal right to step in at the last minute and buy it from under you for the same price.
Wow, so you do all the work to find the deal, you negotiate the price, and then the neighbor can just swipe it at the last second.
Exactly. It's a deal killer for most foreign investors. They won't touch it. But the AI identified a leverage point. It found that the seller had a specific urgent debt of $200,000. It wasn't a huge amount relative to the value of the asset, but it was extremely urgent for the seller.
And the term they used was leveraging seller desperation.
It sounds ruthless, but it's data-driven leverage. The strategy was to use that urgent liquidity need to force a faster sales structure, one that might bypass some of the slower bureaucratic hurdles simply because the seller couldn't afford to wait for the local farmers to organize their financing.
It's using data to find the one pressure point that changes the whole dynamic. These case studies really show that we aren't just talking about a database of phone numbers here.
Not even close.
We're talking about deep, strategic analysis.
Exactly. But with great power comes great risk and competition.
Which brings us perfectly to segment 5. Risk, ethics, and the competitive landscape. If this tool is so powerful, surely everyone will want to use it. And if everyone uses it, does the advantage just disappear?
That's the competitive lockout concept that's mentioned in the Synergy AI sales playbook. Their pitch to family offices is what they call the white label strategy.
Okay.
They tell a firm, buy this technology, white label it as your own internal system, and you gain what we call immediate proprietary competitive advantage, IPCA.
So the pitch is basically, buy this weapon before your competitor does.
Precisely. And it directly threatens the incumbents. Traditional brokers, and especially those black box databases like Syndex or even just generic CRM wrappers, are in real trouble. If you are just selling access to a static list, you are obsolete. You need to be selling insight.
But we have to go back to the hallucination risk. We can't ignore it. The sources call this the hallucination battleground.
It is the battleground. Because if you're going to make million-dollar decisions based on an AI's output, you need absolute verification. The sources emphasize cross-referencing as a key feature.
Could you give us an example of that, how it works in practice?
Sure. The AI reads a company's annual report that mentions, say, a major property sale. Then it checks the virtual data room, VDR, to see if the notarial deed for that sale is actually there.
I see.
If the deed is missing or if the price on the tax form doesn't match the number in the financial statement.
Red flag.
Massive red flag. That is automated verification. It's using the AI to essentially police itself and flag inconsistencies for the human user.
And that leads into the final module they talked about, the Synergy Fraud Sentinel. I feel like this is increasingly important. We've seen deep fakes, we've seen totally fake companies raising money.
The Sentinel is designed to catch exactly that. It automatically checks for registry mismatches, it runs sanctions checks against global watch lists, it looks for shell company patterns.
What's a shell company pattern? What does that look like to an AI?
Things like a company claiming huge revenue but having no employees on LinkedIn.
Mm.
Or its registered address turns out to be a P.O. box in a known tax haven. Or the directors are linked to dozens of other dissolved entities. The AI can spot that pattern of mismatches instantly.
It validates that the counterparty is real.
And that they are who they say they are. In a world of automated outreach, verifying that you're talking to a real human being and not a bot or a sophisticated fraudster is absolutely critical.
It's the trust but verify model, just automated.
It has to be. The stakes are too high.
So, bringing all of this together, we've gone from the raw frustration of data overload to this really coherent vision of an agentic deal maker.
It's a complete shift from search to scan. Search implies you already know what you were looking for. You type a query. Scan implies the system is constantly looking on your behalf. It's monitoring the entire horizon for signals you didn't even know mattered.
And the efficiency gain is just undeniable, compressing weeks of diligence into mere minutes.
But the real strategic game, the long-term win, is that data moat we talked about. The firm that adopts this first and spends years training the model on their specific logic, their wins, their rejections, they build an asset that cannot be copied.
That's a powerful thought. You can buy the software, but you can't buy 5 years of a competitor's institutional memory that's been encoded into the AI.
You can't. That's the moat.
So for our listeners, the learners, the investors out there, what's the provocative thought to leave them with?
I would ask this. If the winner in M&A is no longer the firm with the biggest network, the best golf buddies, but the firm with the best algorithms for signal detection, what happens to the relationship business of deal making?
Yeah. Is the handshake dead? Is that what this means?
I don't think the handshake is dead, not at all. But I think the role of the human is fundamentally shifting. We are moving toward a world of algorithmic deal makers, where the human's primary role shifts from finding the deal
to closing the psychological gap.
Exactly. I think that's what's left for the human. The human has to be the one to look that founder in the eye and say, we are the right home for your legacy.
The AI can predict the succession crisis, but it can't comfort the founder about selling their life's work.
It can't. So the human becomes the closer, the psychologist, the trust builder. The AI handles the cold logic. The human handles the emotion.
That is a fascinating future. High-tech sourcing, high-touch closing.
That's the model.
Well, that is all the time we have for today. A deep dive into the agentic age of M&A. It sounds like the future's already here, it's just, unevenly distributed. Thanks for unpacking it all with us.
My pleasure. It was great.
And to our listeners, keep learning, and we'll catch you on the next deep dive.